The following program may be pre-recorded.
The following program is sponsored by Max Out Savings Advisors. The views expressed during the broadcast are solely for entertainment purposes and do not necessarily express the views of KNTH, its management, Max Out Savings Advisors, or its sponsors. Max Out Savings Advisors and members of the Max Out Savings team may or may not hold securities mentioned during the show. Plan for your prosperity. Prepare for your retirement. Safeguard your savings. And nurture your investments. This is the Max Out Savings Show with Ted Gioka, a presentation of Max Out Savings Advisors. Now, here's your host from Max Out Savings Advisors, Ted Gioka.
Welcome to the Max Out Savings Show. I'm Ted Gioka, and we're talking savings, investments, in your retirement on the show. Our show is all about saving money, building up wealth, and understanding the world today. We try to take ideas that you maybe aren't hearing elsewhere and bring them to you, different takes when we see things. If we feel like this is, the mainstream media is giving you the correct read on things, then we want to see you get what we think is the way to go. So that's our program, our strategy, and our motto is to save aggressively and invest conservatively. That's save aggressively, invest conservatively. That's the key to building up wealth over the long term. Now, we got quite a bit to talk about on the show today. Looking out, it's an interesting. We're coming up here. Labor Day weekend, things tend to quiet down, and we want to see what's happening, where are we so far year to date, and we want to look at a couple different things here. If you look at the market, the S&P 500 is up about 10%, and if you look at there's a lot of talk about the Mag 7 stocks, and they're up some, but not up nearly as much as people think. And so what we're really looking at here is just a volatile market. Interest rates have fallen year to date. The precious metals have actually outperformed, have vastly outperformed the S&P 500. And this has been, and we've been saying this for a while. We're seeing central banks are buying very large amounts of gold. And some of the central banks, I think now have more gold than dollars. And that's not correct, but they've been buying more gold than dollars here recently, and stockpiling gold. And we warned that this was going to happen. Once the United States froze the Russians' funds at the Federal Reserve, most countries around the world realized that they had to come up with an alternative to the dollar, just because they couldn't have all their proverbial eggs in one basket, and the U.S. get mad at them and shut them down. And if you look at on so many ways, the Ukrainian war, which is a great idea for a bunch of neocons in Washington, on how to destabilize Russia, has turned into just a complete disaster for the United States and hurt our credibility around the world. And we put sanctions on people, and other people aren't doing business with us. And now they're trying to find an alternative to the dollar. The BRICS are trying to come up with the currency, and it's just the strength of the dollar has really been the financial of the U.S. The United States has been the financial system and the U.S. dollar and the banking system. But if we kick off major countries off of it because we're in a dispute with them, then what you run into is a situation where people have to have alternatives to the dollar. They have alternatives to the financial system, alternative to the SWIFT system, which is the payment system. And so these are kind of very complex issues, but you need to understand them. Look, if the United States is directly threatened, absolutely we need to cut them off. But just to basically assist in policies of the State Department is just foolishness. And so gold is way outperformed in here. And so how does this all affect your retirement? And I think how you have to look at it is a couple things. Retirement is long term. It's 30, it can be 25 to 30 years. The average married couple has a 50% chance one of them lives into their 90s. We've got numerous clients in that situation, and we kind of see the effects of it. So you have to shepherd that money over a 25-year period, where so you don't run out of the money, which means you have to think long term. One of the more fascinating things. I've been in this business a long time, over 25 years now, and there's some things that just I've always kind of accepted as gospel, but looking back on it, and one of those things is the idea that the comment of once you retire, I think bananas we're going to ripen is long term. And that's really not the way it works. When you're retired, you actually have the ability to think much longer term because you really have a set income, you have a set amount of assets, and you have to manage it through. So you can't fall back on I just make more money that most people do. And you also have the experience of a lifetime to be able to do that. But you retire at age 65. Well, you could easily live another 30 years, you or your wife, and so you have to sort of plan longer term, and you have the ability to think longer term. And in the world today, everybody's fixated on the S&P 500 and what NVIDIA's earnings are going to do. You have to be laying in investments for 3-4 years into the future, for 5 and 10 years in the future, and look at different asset classes, look at things, ways to go. You look at the markets right now; they're pretty expensive. Things are doing well, but if you look at it, you're looking at about a 23 multiple. Well, that's pretty high. But if you look back through history, every single time the markets have had a 23 PE, you've been looking at returns of over the next 10 years, because remember, we're talking 25 to 30 years retirement. The next 10 years are 2% to negative 2% every single time. So once markets do well and get real expensive, can they go up another 10 or 20% or more? Yeah, but the danger is out 5 years in the future, and that's as a retiree, you're typically taking money out each year. And where you get damaged the most, strangely enough, is early in retirement. That's what the research says: is if you retire and put all your money in the S&P 500 and it falls apart and drops 53% like it did in 2008, that wipes out a good chunk of your retirement. And so instead of $1 million, you get $470,000, and you're in real trouble. And this is the mistake a lot of people making. A lot of people really guards are really down quite a bit. And so what you want to do is have a kind of a more broad-based return across numerous asset classes to kind of protect yourself. And we've talked a lot about the S&P 500. The top 10 stocks are about 40% of the value. And most of those, I think the 7 or 8 of the top 10 are tech stocks. And in the S&P 500, we've talked about it. And what they've kind of done is they have Apple, they have Amazon is consumer discretionary. You see, one of them is also defined as communications or something. I think it might be Meta or something. And so 3 of the top of the Mag 7 are not they're not defined as technology stocks. But if you go through Apple, Amazon, Microsoft, Google, Meta, and Tesla, the big stocks, that's 6 of them, but those are all tech stocks, clearly. But the S&P, and the reason the Standard & Poor's did that and then put Amazon over there, although it's the biggest cloud provider in consumer discretionary, is because I think Apple might be communications, I forget, but the reason they did that is because if these things were all classified as tech, and you've got maybe 30 5% of your portfolio in technology, there's nobody out there could justify that. And so this is, almost any way you look at this market, it's just expensive, and it's something that we want to watch out for. I mean, the Mag 7 are at 48 times free cash flow, which is the highest ever, and so you want to look at in other areas. You want to continue to diversify and to protect your portfolio into stocks, the bonds, other stocks. The tech stocks are mostly growth stocks. You look at value stocks. You look at overseas stocks has actually outperformed the markets for the first time in a long time this year. And so this is kind of just sort of some understandings of we want to talk about this to some extent because, so much of the retirement money is in the S&P 500, the majority of it really. And it's clearly the majority of it. If you put in, a lot of people are just shadowing the S&P 500. I mean, I can't tell you how many portfolios we look at and we're like, these people are just shadowing the S&P 500, and so everybody's kind of in the same game. And so by looking at other alternative asset classes, by alternative I don't mean private equity or something, but I just mean spreading your risk out across different things. That is going to get you. There's always money to be made in the market, and it'll get you kind of where you need to be. So those are just some of the thoughts. Because again, understand a retirement portfolio that you should be taking out. You can take out about 4.5%. There's some new numbers coming out. We're going to discuss that one upcoming show. That's about what you can take out of the S&P. Out of a diversified retirement portfolio in stocks and bonds. And so you're always taking that money out, and so you need income from various sources, and what you need to do is have different asset classes in there that if one of them goes down, another one will come up and stabilize the portfolio. And so this is something to think about. Keep in mind, it's Labor Day weekend. Things have been pretty quiet in the markets. Nothing to see there. But typically after the holiday, people come back to work, and that's when you're going to get a lot of movement. Typically, that September, October, people start planning for the new year. The banks kind of reduce liquidity, start moving things around a little bit. And this is when you get September is typically the worst month of the year, and people over the summer, they're not paying any attention. They're at the Hamptons. Although I don't get the draw of the Hamptons, but that's another story. But they're somewhere else, and I think in Houston we can all appreciate that to some extent with our Houston weather. But so anyway, that's kind of really so expect a lot more volatility coming up after the holiday here, and expect a lot more movement. I mean, these markets have almost been like watching paint dry. That's likely to change, and so the question is, what's it going to go in? What direction? What's it going to go, and what's going to happen? We're going to discuss some of that right after this quick break, right here on the Max Out Savings Show.
The Max Out Savings Show with Ted Gioka is taking your calls now at 713-339-1070. Ted Gioka will return after these messages.
I'm Sam Malone, president of 512 New Media. We're Houston's leading marketing and content creation firm for many reasons. Our assets are exceptional, from video production to web design, strategy, and the ability to say no. Saying no is integral in launching a successful, profitable campaign. For example, take a look at Memorial Day. It's a federal holiday set aside to honor and mourn those in our U.S. military who died while serving our country. I'll say it again, for those who died while serving our country. So how does having a sale work in unison with the reason for the day off? Look, we know people will be at the beach and barbecuing and having parties. We would probably say no to launching a Memorial Day sale. So is there another way to commemorate the day while marketing your brand? Absolutely. And from our experience, the same holds true with Easter Day sales and MLK Day sales and Christmas Day sales. That's why we're different. No cookie cutter, follow the crowd, template marketing. Let's talk. We're 512 New Media. 512 New Media. With better marketing comes better value, creating better results.
In the 1970s, the big song was the Bee Gees' Stayed Alive. Well, it was difficult back then to stay alive if you were a retiree. Inflation was running rampant, and since then, over the last 25 years, it's gone away. Well, inflation's coming back, and it's going to endanger your retirement. If you're a retiree, inflation is your biggest enemy. Hi, this is Ted Gioka of the Max Out Savings Show. If you need help with your retirement, I'd like to help you out. Go to maxoutsavings.com. That's maxoutsavings.com, and we'll show you how you manage through inflation. Don't let inflation destroy your retirement.
And now, more of the Max Out Savings Show with Ted Gioka.
Welcome back to the Max Out Savings Show. To get any questions or comments, you can call at 713-339-1070. I wanted to just touch base on the story with Lisa Cook, a Fed governor that President Trump has fired. And this is kind of a big story. And then listening to some of the stuff this week on this, the commentators, they're missing the point. The point isn't whether President Trump has a cause to fire them, or that President Trump acted, unconstitutionally. Where the real issue is people need to understand the Federal Reserve regulates the banks. And the bank's main thing is lending. What Lisa Cook did was she refinanced a house or bought a house, whatever, and then said it was her primary residence. And then 2 weeks later, up in, I think, Michigan or somewhere, and then 2 weeks later in Georgia, she had another house, and she claimed that was her primary residence too, and also claimed that it was her primary residence. And why this is important is if you have a house that's a vacation home, it's a different set of lending standards, and the interest rates tend to be higher. Sometimes it's just a quarter of a point higher. Sometimes it's more. Now, I'm hearing that she had a third home that was an investment property that she reclassified as a vacation home. Well, then you're looking at the interest rates likely would be 1 point higher. And so we have a couple things here. And so this was not a clerical error, because it happened three times in her favor. But keep in mind, it's not just the interest rates, but it also has to do with the taxation to a lesser extent, but also insurance. If it's your primary residence, the insurance is lower than if it's a vacation home or an investment home. So what she's doing is she's reducing her cost and for expenses of her home. But the problem is she's a banking regulator, and she's a Federal Reserve governor. And if the Federal Reserve governor, why should anybody follow the rules at the bank if the Federal Reserve governor? And by the way, her resigning is not like the first time. We've had I think 3 governors in the last 5-7 years that have resigned due to trading, stock trading, and it wasn't it wasn't like insider trading where they bought Pioneer or something and it got taken over the next a week later type of insider trading. It was just more of they were trading back and forth on what could be perceived as, hey, if the Fed's going to be cutting rates, that's a positive for the stock market, and so it just looked bad. It didn't violate any laws per se. They resigned. In this case, what Lisa Cook did was it was mortgage fraud, and pretty clearly, and they And one of the ways they found out, the numbers, I think it's about a little over 40,000 people have kind of done the same thing. And they're realizing that, wait a minute, you can't just have two homes and they both be your primary residence. And this is something, because what's happening is people that are following the law, they're having to pay higher interest rates. So why should someone that's following the law have to pay 1% more on a home interest rate while people that are cheating are getting a discount? And if you're in that position at the Fed, it should be unblemished. I mean, these people on the stock trading, it was just kind of a gray area. They did not break the law or anything. They asked him to resign. And so I think Lisa Cook should resign. I think she should have been smart and just walked away from this thing and just said, "Hey, I'm sorry, and it was a mistake," and resign. And she should have walked away. And it would have probably been. And now it's kind of forced the government to sit there and really prosecute her for it. And they probably need to talk to all these 40,000 people that did two things to see what they're doing too, and they need to clean this type of stuff up. Now, why this is such a big deal is important is because President Trump wants to get his people on the Federal Reserve. He's been pushing Chairman Powell to reduce rates. Now, here's a couple things. The average weighted coupon of the debt right now is about 2.9%. And keep in mind, we've got over $1 trillion worth of debt we're paying every year, $1 trillion a year just in interest debt. Okay, stick with me, Charles, and we'll get in a second. But if you right now, so the current debt, if you look at all the debt, the average weighted coupon is 2.9. Well, if you look at interest rates now, 3 months is at 4.1, 6 months is at 4%, 12 months is at 3.8, a 2 year is at 3.6%, and a 10 year is about 4.2%. So it goes up a little later. Those are all higher than 2.9, which means as the debt comes due, it's going to be refinanced at a higher rate, which means interest on the debt is going to go up, which means our deficits are going to go up. So President Trump would like to get this closer to 2.9, so at least the interest cost doesn't go up on us. And that's what this big battle is at the Federal Reserve. Now, he wants to appoint the guy, Merriam, I forgot his first name. We're going to discuss some more on him in a future show. But he's one of the guys that some of the restructuring that they want to do of the whole government debt and all these other issues. But one of the main things is it rests on having the ability to lower our interest rates so we can lower our interest cost that's over $1 trillion, which means we can lower our budget deficits, which are running over 6% of GDP a year. So if you take if you lower interest costs, that helps out. If you get tariff money coming in, that helps out. If the Doge Commission cuts $200-300 billion, that helps out. If they find the economy gets a little better, it all helps out to reduce the deficits, and we grow our way out of it. Now, So this is what the big battle about Lisa Cook is. Everybody knows Lisa Cook's going to have to resign, but they want to hold off because Trump wants lower interest rates and he wants to lower the dollar because he has $38 trillion worth of debt. Every time I say that number, every time I say $1 trillion, it amazes me because I've had to really do research to understand what $1 trillion is. And it's so big. If you put it in the number of seconds, to counting, it's like 25,000 years or something. The numbers are absurd with it. But we have $37 trillion worth of debt, which we've got to sit there and grow out of. Anyway, let's take a call from Charles to the Max Out Savings Show. Morning, Charles. Charles, you there?
Oh, yes, I'm here. Just to follow on your comment, I don't think, regardless of political affiliation, we should have people either in the Federal Reserve or in any government agency engaging in fraud. This is the third person besides Adam Schiff and Letitia James that has pulled this stunt. and obviously, as you correctly pointed out, there are tax ramifications, and they're getting favorable tax treatment as a result. So to me, I think you just have to let the chips fall where they may. But Ted, I have two quick questions I'd like your opinion on. The first is President Trump has talked about bringing in 600,000 Chinese to teach. To attend these schools here in the country, and I don't quite understand how that is putting America first. I don't know the ramifications of that.
Charles, no, that's a good question. They had to clarify that, and it's 300,000 this year and next year. There's a certain number of Chinese students in the country, and I'm kind of with you. And I think they want to have some Chinese because they do want to have some cross-border things. I mean, look, some of these I know for a fact that I won't mention any specific schools that I might have gone to, but I know for a fact that they've had to expel some of the kids for espionage up there, the Chinese students.
Well, right. And I would say this, Ted, I mean, are we sending any of our people over there? In other words, this seems like it's a one-way street. And, we've got our educational system is, really is woefully inadequate in many respects. We should be, to put America first, we should be teaching our own people here, whatever we're spending to educate these people from a country that's got missiles pointed at us. I would think that we would want really to be, upgrading our own people's skills. But to follow the second question,
I think that's a good point. Yeah.
And the second question I have, Ted, is this: this business of the country taking equity positions in Intel, and now they're talking about possibly, and you may have heard this too, on some of the companies in the defense industry. I personally believe that the government and the private sector should be separate, and government should be sticking their noses into companies' balance sheets, because to me, maybe you can trust President Trump on this, but the next administration is going to look at this and say, oh, well, we can take this, further. We're going to take 50% on Exxon or something, and here's what we want in return. I think this to me is kind of scary in my mind. And I've spoken to people about this, and they don't feel comfortable at all about this. What are your thoughts?
Charles, look, a couple things. I think the Chinese is just 300 and 300. Look, some of the schools, particularly like NYU and some of those East Coast, they've got 20, 25. I think one of them had 30% foreigners, and American kids aren't getting into the schools, which is, and that's a real problem. And Trump is cleaning that up. I think he misspoke. He did say it's just going to be 300,000, and we do want to have some of these people here. But we need to make sure that our kids get in first. The other question, I think, as far as look, I agree with you. I think Intel's maybe a special case where it's, look, this is a national security issue where we have to get these factories going. And one of the problems is I think about $8 or $10 billion was going to go to Intel to build out. They weren't going to hit so they had to hit certain milestones, and they weren't going to hit them. In addition, there was a bunch of DEI, garbage in there and environmental stuff as well. And look, they've got to just get these factories going. And I think they should have just cleaned up the grant and given it to them or something. I'm not that upset about Intel, but to your point, I think this should be rare and not often for companies in trouble that we deem as national security issues.
Right.
The stuff about.
Yeah. Go ahead.
The stuff about look, I'm not comfortable with it because, as you point out, then they can sit there and say Exxon has a down year. Well, they could give them a couple $1 billion, but then they want ownership in the company. Then they start wanting to say, well, you can't drill here, you can't drill.
Correct.
And it opens Pandora's box. And the other thing too, which I'm very uncomfortable with, was I think it was with a couple. I think it was NVIDIA and another one of the companies, where they're getting like 15% of the revenue. Again, it's to your point, Trump. Look, I support what Trump's doing, and I think Trump has good intentions. But the problem is we're going to get people with bad intentions like Obama,
Correct.
Biden, and then they're going to want what's to say, the proverbial Exxon, any oil exported, they get 10% of that, and it's really the opening Pandora's box.
Exactly.
So yeah, I agree. I really wish he would. I'd like to see him cut this stuff out because they need to think long term. And I understand Trump's a businessman and really wants to do what's the best interest of the United States, but he's not always going to be in power. Then what do you do?
Yeah, and just one last comment, Ted. I noticed that there's been a lawsuit filed against this ChatGPT. There's some couple or family out in California that's now suing, and I don't know who owns the ChatGPT, but they're suing the company now because it led to their son's suicidal death. So I'm not sure what that means in terms of his AI business, but that may be something that now people may need to start thinking about as well. So I'll just leave you with that, though. But anyway, thanks for your comments, Ted.
Okay, thanks. I mean, it just goes to show you that this AI has to have a morality to it, and it's one of the real dangers of AI. And by the way, if you look at AI this week, a lot of the stocks were down pretty big, and it was an MIT study that came out, and basically, I'm going to paraphrase it, but about 60% of the companies it was 80% of the companies were looking at AI and getting processing AI, but only like 40% of the companies were actually doing anything with AI, and only about 5% of the companies felt their AI program was successful. And we're spending enormous amounts of money on AI. And I mean, to the point of we're trying to ramp up, increase electricity by 50 to 100% in the next 5 to 10 years. It's just across the board. The numbers are so big that the big tech companies are starting to run low on funds. And the question is, what the MIT studied is, look, all this AI has not been successful. One of the more interesting things was that they're finding that some companies have these AI programs that their employees can use and stuff, and they're finding the employees, like the minute they walk out of the room, they're going to ChatGPT or to Grok, and because they trust that more than the AI at the company, or it works better than the AI at the company. So this is a long-term process, but the real issue with AI starts coming in is how much money are we spending here on this stuff? I had some numbers here on AI. Where was it? Okay. Tell them to hold through the break. We'll get them right after the break. But the numbers on the AI is if you look at Meta, well, actually, the Magnificent Seven, about 82% of their free cash flow, is going to dividends and stock buybacks. Now, Meta's cash positions is dropping pretty dramatically, and I think it's down about 40% because and now they're doing a huge AI project in North Louisiana. They're having to use, I think, a couple of the PIMCO, Blackstone, or a group of them to try to fund it because they're running. Where's all the money going to come from this? It's trillions of dollars, and if 82% of the cash flow in these companies is going to dividends and stock, and they're launching these massive capital programs, they're going to have to cut the stock buybacks, and these stocks are at record high levels. And so I think many of these companies, they're in the process of really topping here. Enormous amounts of CapEx is being. There's an enormous amount of financial shenanigans going on in these companies, because how is that CapEx skyrocketing like it is, and these companies continue to make money? A couple things. They're doing off the books deals with for like the data centers, but they're also extending out the depreciation schedules, possibly more than I think you're going to see some real in the future real Enron type of stuff has come out of these companies to try to kind of camouflage the effect of the CapEx on the earnings. Anyway, so what? Let's take a quick break and we'll be right back right here on the Max Out Savings Show.
If you've got savings and investment questions, Ted Gioka has answers. Call the Max Out Savings Show now at 713-339-1070. We'll be right back.
Hi, this is Ted Gioka of the Max Out Savings Show. Our motto and philosophy is to save aggressively and invest conservatively. The world is changing at a faster rate than any time in the last 50 years. The investment world has changed. Have you changed? Inflation will destroy your retirement. It is a different world that requires different strategies and ideas. The era of indexing and investing is over. If you need help, listen to the Max Out Savings Show. Our show airs every Saturday at 10 a.m. and Sunday at 7 a.m. We talk about investments, the world, and where the world is going today, and help you understand it and help you save money and build up wealth. It's the Max Out Savings Show. And if you need some help, go to our website, maxoutsavings.com. That's maxoutsavings.com. On the website, you can sign up for the free Max Out Savings Report. Our report covers all types of these big issues, the changes in the world, and helps you understand and protect your retirement. So go to the website, maxoutsavings.com.
Hey everybody, Charlie Kirk here. Ted Gioka, the founder of Max Out Savings Advisors, always says, save aggressively and invest conservatively. He specializes in helping people grow their retirement account with as little risks as possible. Ted combines working knowledge with the intuition gained from over 25 years of experience of value investing in the stock and bond markets for retirement accounts. Like you, Ted is deeply conservative in life and in his investment approach. His risk strategy allows him to anticipate market downswings to protect your money. Ted is also the conservative host of the Max Out Savings Show. You can listen to him every Saturday morning at 10 a.m. right here on The Answer. If the idea of saving aggressively and investing conservatively appeals to you, the best way to get to know Ted is to call him. The number is 713-627-0400 or visit maxoutsavings.com. That is maxoutsavings.com. Call Ted right now, 713-627-0400, or visit maxoutsavings.com.
If you can snap your fingers, you can find this radio station. So the next time you want to listen to us, your smartphone is now your smart radio. We're always on. This is AM 1070, The Answer.
Once again, here's your host for the Max Out Savings Show, Ted Gioka.
Welcome back to the Max Out Savings Show. I'm Ted Gioka. We're talking savings, investments in your retirement. I want to just mention one of our sponsors, Rangoni Alto Gin. It's a fine botanical gin from the Italian Alps. They use the finest organic botanicals they've been doing for hundreds and actually even thousands of years up in the mountains. Thanks. Phenomenal taste profile, almost closer to a fine wine. If you get a chance, try it out. It's Rangoni Alto Gin. You can get it at Specs or Total Wine, and it's look for the kingfisher bird on the label. So I think we have a call coming in. Welcome to 713-339-1070. Welcome to the Max Out.
Hey Ted, this is I'm sympathetic to Chairman Powell. I think we have a huge inflation problem in this country. Trump's aggravating it by slapping a national sales tax on everything in the name of a tariff. And then all these jobs that are going to be created here, they're going to be at higher costs. So, to pillory Powell for not wanting to drop these rates down, I think is wrong. We drop them too far and the dollar's going to collapse.
Yeah, this is a good point. And this is, I mean, the point is, look, we have inflation going up. It's 2.3, and that's a lot because gas has gone down, and we haven't seen the full effect of the tariffs, and we've got the economy doing pretty well here. We got the stock market at all-time highs. Why are we cutting rates? And now I think what the Trump people are saying is, guys, look, we've got this deficit. I mean, technically, the Federal Reserve is correct, but the problem is they've taken themselves out of the discussion about the debt. And they, under Joe Biden, they didn't say a word as the guy recklessly spent money, unlike we've ever seen in the United States of America. And so they've taken, and they didn't say a word. So they're not looking at the deficit. They're not looking at interest rates. And so they've got to get these rates. It's called financial suppression. And what they're doing is which means you're going to get less for your money in the future because they're going to artificially keep rates down to pay off the deficit. That's what we're dealing with, and this is a great question because the answer about the dollar going lower is because I think Trump wants the dollar lower. I think they want the manufacturing back in the United States. I think they want the jobs back in the United States, and I think the COVID was a real wake-up call of what happens when we lose China. I mean, we're scrambling just like the Russians when they lost the ability to use the dollar, their money at the Federal Reserve. Everyone started buying gold. Well, the same thing. We've got to get this manufacturing back here because the Chinese. We could be in some incident with them, and then they cut us off, and then what do we do? And so. And I think it's Steve Marion, I think is the guy he wants to put in the Federal Reserve in place of Lisa Cook. He's the architect of this Trump plan to push interest rates lower and the dollar lower to bring the manufacturing back and the tariffs to bring the manufacturing back. So as a long-winded answer to your question, the Fed to some extent is right, but the problem is they're not looking at the interest on our debt.
Well, you may invite another Volcker in about 5 years or 4 years because I don't see a happy ending to this.
Well, I can't.
Yeah, I mean, I don't know. Yeah, and I know that no home builders are building homes today, and I don't know if many car manufacturers can even sell their cars unless they make some ridiculously low payment rates. The economy is stuck.
Yeah, look, I mean, one thing that this is, Trump was given a bad hand when he came in. I mean, it's just, Biden recklessly spent the money and stuff. And look, a lot of our listeners, because they're younger, don't remember Paul Volcker. I was always fascinated with finance and stuff from a very young age. And Paul Volcker, when he appeared before Congress, those people were afraid to ask him a question. I mean, because he would blow back on them, and it's like, what are you doing spending all this money? You're wrecking the economy. You're destroying the economy for our children. And the Fed kind of took themselves out of and it was only the Obama and Biden administration convinced the Fed to say, look, we had what's her name, Stephanie Kelton, professor at Harvard, came up with this modern monetary theory where you could spend as much money as you want. Well, in order for that to work, the Fed couldn't say anything. Well, they need, to your point, they're going to have a Paul Volcker step in, and eventually they're going to have to get where he goes down to Congress and goes, guys, what are you doing? You're wrecking the country with this spending, because right now they're all getting away. I mean, Trump came up with this big, beautiful bill, and the Senate loaded it up with a bunch of pork on top of it. And so this is what we're dealing with, and you really have this kind of bifurcation where the Fed is looking at this very narrowly, and they're correct. But if you open the aperture up and really look at that debt and that interest payment of over $1 trillion, they've got to do something. And the dollar, to your point, is likely going to go lower. This is why we like the real assets versus financial assets, because I think you're going to see. I think there's going to be there's a huge demand for money, massive government spending, massive need for money on AI build out and stuff, and so all of this is going to create issues out there. They're going to be swirling around into the fall and into next year.
You're going to see $4,000 or $5,000 gold without a doubt because of this mess. And I don't know. I don't want to take time because you got other viewers, but did you know in Florida they've legalized gold as a form of payment next year?
Yeah, gold is looking really good. And thanks for the call. I mean, this is a good point. Look, gold, I want to say it was one of the countries, I think Vietnam is allowing gold to come in now and trade freely. I mean, around the world, central banks are buying gold. We really like silver. Silver Friday traded on the futures closed, I think it closed at $40, which is a big deal. It hadn't traded there in 14 years. I think silver's going a lot higher. It's going to probably have a better move than gold in here. The stocks are really looking good. The earnings are looking good in these companies. Newmont, I just noticed, is actually cutting they're cutting jobs and expenses. And one of our themes with the precious metal stocks has really been that that the precious metal stocks are where the oil companies were about 19, well, not were, but 19, when 2020, when oil plunged to down to $30, the oil companies are like, look, we're done. We're not going to overproduce and get as many barrels as possible and make no money. So they cut back their growth programs. They sold off fields. They cut back workers. They reduced costs, bought back stock. They paid down debt. Much better companies. I think energy still looks good. Energy's cheap in here now. It depends on what the economy does, but natural gas, I think, if you look long term, energy should do well with all the AI and everything. Housing, to the caller's point, this is another area that we really think there's a slowdown. One of the things we're different on the Max Out Savings Show is we're saying, look, this economy is slowing to some extent, and housing is slowing to some extent. One of the reasons for both of them, not the total, but is, look, illegal aliens are afraid to spend money out there right now. Not every illegal alien came in, the last year of Biden's administration, but some of these people have been here 5, 10, 20 years or more, and now they're not sure what to do, and that's slowing things down. Housing is still too expensive out there. Interest rates are high, and I don't think housing bottoms until the fall here later, and I think housing prices need to go low. I mean, we've all had kids that are complaining about the cost of housing. I mean, if you're an older person, a boomer or something, retired, I mean, the housing prices are great. You're up, your house is worth a lot more money. It's exciting. But if you're a young person, you're like, what's going on here? Why is this house so expensive? Dad, I'll never be able to afford this. And I mean, of course, we all thought that at the time, but it's much worse than it used to be. I saw some numbers on wealth around the world, and a couple of things jumped out. The wealthiest places were like Hong Kong and Singapore, and the United States was way up there, which is really interesting because it's a big country. But Australia is one of the top ones. Like Australia, what do they have down? They have a ridiculous housing bubble. You think housing's expensive here, you should see Australia. And so, but I do think housing prices are going to come down in here, and so that's just kind of what we're looking at there, and that's kind of what we think you're going to see somewhat of a slowdown into the fall. I think next year there's a lot of factories and things coming back to the U.S., a lot of capex, a lot of industrial production. That's going to do well, but a lot of these factories that have all been announced, and I think there has been over $1 trillion announced. We're using $500 billion. We think, look, there'll be $500 billion in factories come back, but you got to get the permits for the factory, so that's more likely to start next year. And you start construction of the factory, you got to bring in the equipment and hire all the people, and so I think you got a little trough into the fall. If you look at China, China was taking. Well, I think they came into the World Trade Organizations in '94. They started taking jobs immediately. And by the way, one thing to be fair to China, it's not like China, came and stole all our jobs. U.S. companies contracted the stuff over there because they could make the product cheaper and boost their margins. If you look at the margins in the S&P 500, it's at record highs. The margins went up during inflation. That's very rare for that to happen. That just means they have pricing power. But they basically boosted their margins up by, hey, we can make the product 20% cheaper in China, and then they didn't cut the prices 20%. They just put it to their bottom line. And so I think we need to, really understand, well, now it's time for these companies to come back here. Maybe it's going to cost you some margins, but it's in the best interest of the United States. So, it's a complicated world. What Trump is trying to do is very, very complicated. I mean, he's dealing with, you have to sit back and look at this thing, and Trump comes into office. He's got $37 trillion worth of debt. The interest cost is, and he's adding $1 trillion. We've been adding $1 trillion for years now. $1 trillion every 120 days. Additional debt. The interest rate is like $1.1 trillion or something like that. he has to come up with a plan. And as some of our callers pointed out, is the plan is he wants to push down interest rates. One of the Fed governors resigned earlier, about a month or so back. He put his person in. Lisa Cook committed a mortgage fraud, it looks like, and at least not once, but possibly twice. She's going to be gone. He's going to put Marion in. He's going to get his guy in there, and then he's going to have he's probably near the end of the year, he's going to announce a new head of the Federal Reserve. So he wants his team in there. He wants lower interest rates, and he wants financial repression to keep interest rates lower, to cut the deficit, to cut the interest expense, to cut the deficit. And probably going to see the dollar lower. That's going to be good for financial stocks. So all of these things, this is why for the last couple of years we've talked about commodities, about things. As we talked about, look, massive build out of electric cars, massive build out of AI, massive build out of manufacturing back in that. So that all takes huge amounts of aluminum, copper, lead, zinc, silver, gold, all of these things, oil, energy, and that's where you're going to see the growth going forward. I think the people spending the money, the Meta, the Microsoft, the Googles, it's going to be tough. It's going to be a little tough on them because they're having to spend a lot of money, and so I think that's more top. Anyway, those are some of the things we write about. A lot of this on the Max Out Savings Report. If you want a copy, go to the website, maxoutsavings.com. That's maxoutsavings.com. You can sign up for the free Max Out Savings Report we send out once a month. Well, to be fair, it didn't go out last month. It's the summertime, but we'll get it out. Sometimes we put out 2 in a month. And also, if you need some help with your retirement, if you have an old 401k, that's what we do. We manage money using our value investing approach to the stock and bond markets. And we hold the assets. Our custodian is Charles Schwab, and then we manage it for you using our program. If you'd like to meet with me, I'll sit down with you here in Houston, Texas. Just go to our website, maxoutsavings.com. Get the phone number and give us a call. It's maxoutsavings.com, or send me an email. And if you need some help, I'd like to help you out, but at least sign up for that free Max Out Savings Report. Anyway, I appreciate everyone listening to the Max Out Savings Show. And also remember our motto and philosophy, which is to save aggressively, invest conservatively. That's the key to building up wealth. We'll see you next week right here on the Max Out Savings Show.